Right now, somewhere, a stranger is betting real money on whether it rains in Miami next Tuesday, on who wins an election 2 years from now, on the price of eggs. It sounds absurd. A casino for literally everything. But look closer, and the people building these casinos aren't really gamblers. They're building something Wall Street has quietly wanted for a century, a machine that turns the future into a number. The boring name for that machine is a prediction market. The idea is old, but the new versions, with names like Kalshi and Polymarket, let almost anyone trade contracts on real-world events. And none of this is as new as it sounds. People have wagered on the future for centuries. On papal elections in Renaissance Rome, on wars, on next year's price of grain. What's new is the technology. An app in your pocket, thousands of strangers, and a price that updates faster than you can blink. Here's how one works. Take a question with a yes or no answer. Will this bill pass by December? A contract pays you $1 if the answer turns out yes, and nothing if it's no. So its price, I'd say 60 cents, is secretly a probability. The crowd is saying 60% likely. Buy it, and you're not just guessing. You're putting money behind your guess, and money, it turns out, makes people honest. Because when being wrong costs you, you stop kidding yourself. A pundit on television pays nothing for a bad prediction. A trader pays instantly. So a market full of people with real skin in the game tends to forecast better than the experts. Better than polls, better than famous commentators, sometimes better than the government's own economists. It's the old wisdom of the crowd, but with a sharpened edge. Only the confident bet big, and only the correct get paid. Trade after trade, the reckless are quietly drained of money and influence, and the price drifts toward the truth. Think about what that looks like. On election night, while the anchors hedge and wait for counties to report, the market has already moved. Thousands of traders pricing in each result the instant it leaks. The odds swinging in real time like a living heartbeat of the outcome. No panel of experts, no polling lag, just money changing its mind out loud. And it isn't only elections. Once you can write a contract on any yes or no question, the menu explodes. Interest rates, box office weekends, whether a tech giant ships on time, tomorrow's high temperature. Some of it feels vital, some of it feels ridiculous. But to the machine, there's no difference. Every question is just another market, another slice of the future to put a price on, which means these platforms are secretly forecasting engines. Every contract is a live poll that updates by the second, weighted by conviction and tested with cash. Aim one at inflation, at a company's earnings, at whether a war ends this year, and you get a real-time readout of what the smartest money actually believes. That readout is worth a fortune. And this is where the story turns. Because you might assume the company running all this is the one doing the betting. Taking the other side, hoping you lose? That's a casino. But a prediction market isn't a casino. It's an exchange. It simply matches a buyer who thinks yes with a seller who thinks no, and then steps out of the way. It never takes a side, it doesn't care who wins. It just skims a tiny fee, a sliver of a cent, off every single contract that changes hands. And that changes everything. A casino can have a bad night. One lucky player can bruise it. This business cannot. It carries zero directional risk. Rain or shine, red or blue, boom or crash, as long as people keep trading, the fees keep flowing. It's the same quiet model as the stock exchange, as the card network that taps a fee off your every purchase, as a toll booth on a bridge. The house here doesn't play. The house owns the road everyone has to drive on. Which brings us to the fight. To a lot of regulators, none of this looks clever. It looks like gambling wearing a suit. State attorneys general have gone to war, calling these platforms unlicensed internet casinos, especially once the contracts start to resemble sports bets. Meanwhile, the federal commodities regulator waves them through as legitimate financial contracts, futures like any other. So the very same product is, at the very same moment, an illegal casino and a licensed exchange, depending on which government office you ask. And the fight has no clean borders. One of the biggest of these markets ran for years on cryptocurrency, offshore, open to the world, but officially off limits to Americans, who found their way in anyway. When a market lives on a blockchain, no single country really controls it. A regulator can ban the app and still not stop the trading. The future, it turns out, is very hard to put behind a national border, and the money is not small anymore. In a single busy election cycle, billions of dollars can pour across these markets. Real capital from real traders, all of it feeding the same machine. That ambiguity is the whole battlefield, because the prize is staggering. Whoever wins gets to host the trading of, potentially, everything. Every election, every economic number, every cultural moment turned into a market you can buy. But there's a deeper reason the smart money is circling, one the casino argument completely misses. The gambling was never the point. The data was. Remember that real-time readout of what the smartest money believes? Hedge funds, banks, and trading desks will pay enormous sums for exactly that. A cleaner, faster signal than any analyst can hand them. So the platform gets paid twice. Once by the crowd placing the bets, and again more richly, by institutions buying the crowd's collective mind. The gamblers think they're the customers. Increasingly, they're the product. It isn't all clean. A market can be gamed. A whale with deep enough pockets can shove a price around to fake a signal, or to move the very headlines that quote it. Thin markets lie. And when a number itself can sway an election or a stock, the temptation to simply buy the number you want gets dangerous. The same machine that makes a crowd honest can be bent to make it lie if nobody is watching the table. There's a stranger loop hiding here too. A prediction can help cause the thing it predicts. If a market says a startup is doomed, lenders pull back, and the odds become the reason it fails. If it says a candidate is unstoppable, donors and voters pile on. The forecast reaches back and touches the future it was only supposed to measure. A very strange kind of power to hand a crowd of anonymous strangers, but watched or not, the machine has a gravity all its own. Put the exchange and the data together, and you see why one company tends to swallow each market whole. Traders go where the action already is. A market with more traders has tighter prices and faster payouts, which pulls in even more traders, which tightens the prices further still. Liquidity breeds liquidity. A copycat launching the identical product with an empty order book offers everyone worse prices, so nobody comes, so its prices stay worse. The gap never closes, it widens. That's why, market after market, you don't end up with 10 healthy competitors. You end up with one giant, a couple of stragglers, and a long graveyard of apps that never found a crowd. This is what investors call a moat, a structural advantage a rival simply can't outspend or outbuild. The New York Stock Exchange has one, Visa has one, and a dominant prediction market has one twice over. The network effect of a crowded exchange, plus a data set that grows richer and harder to catch with every trade that crosses it. Latecomers don't lose because their app is worse. They lose because the math is against them, and this kind of advantage compounds. Every trade doesn't just earn a fee, it teaches the machine, sharpening a data set no newcomer can buy or borrow, only slowly grow. 10 years of the crowd's collective guessing becomes an asset money literally cannot rebuild from scratch. The lead doesn't just hold, it compounds quietly and relentlessly until catching up isn't a question of effort or funding, but of turning back time. The courts haven't settled any of this, and they may not for years. But the direction of travel is hard to miss. Every quarter these markets grow. More money slides across the table, the data sharpens, and the thing regulators are trying to pin down keeps outgrowing their definitions. You can't easily unring this bell. Once a market exists that prices the future better than the alternatives, the world quietly starts to lean on it. So step back from the noise. Past the lawsuits, past the outrage about betting on everything, and the shape underneath comes clear. A quiet toll booth going up across the whole of the future, taking a sliver from every guess humanity makes about what comes next. The casino was never the business. The casino was the crowd. The business is the table they all sat down at. And whoever owns that table owns something dangerously close to a monopoly on knowing what happens next. This video is sponsored by Moats. A liquidity moat like the one we just unpacked is easy to admire in theory. Actually finding those companies, that's the hard part. That's exactly what MoatScope is built for. It rates thousands of stocks on the two things that matter most: how strong the moat is and how much you'd pay for it. Quality times valuation on one simple scorecard, so you can spot the widening moats that are actually trading at a fair price. Check out MoatScope at the link below and go find your next compounder.